You've said that you expect growth this year to be about 2.5% to 2.75%, but now we've got tax cuts, trade tariffs, you've got federal spending, budget deficits. How confident are you in your forecast?
I think for 2018, we're pretty confident. You know, one of the things we do, in addition to supplementing, in addition to the data that you get sort of at the national level, we supplement it with a bunch of surveys. And so we've been asking businesses about, like, what do they plan to do with the surplus, with the windfall that's come? And in particular, we've asked, are you going to spend it on capital expenditures to try to change productivity in a significant way? And consistently, about 3/4 of our survey respondents say, we're not going to change that much for 2018. We'll change a little bit in 2019, but we're really looking much further out in terms of that kind of expenditure. So I think when you think about the real-time impact of GDP on GDP, I think the budget agreement and the spending that's going to come through that has a much more robust impact in the short run.
Well, interesting you mentioned the idea of talking to the CEOs, because I want to ask you, when you talk to them, do they say we need to deepen our capital because we can't meet demand, or we think we can raise productivity? Or is this, they're going to wait and see if they need it?
I think for the largest firms, they kind of know where they are. They think they can increase capacity a little bit, but they still are trying to wait and see about where the consumer is. You know, a lot of the issues around investment have to do with, is the demand there for their products? And that's about the consumer side. And as you know, a lot of the consumer impacts from the tax code, that's going to be down the road a little bit. So I think there's a bit of a wait-and-see attitude. For smaller businesses, it's actually a different story, which is the tax changes were so significant, many of them are still trying to figure out sort of what it means for them in terms of organization, in terms of investment. And so there's a lot of uncertainty that still exists among smaller firms. And so on that side, it's actually kind of a different story.
Well, the administration argues that this can raise potential growth because it will raise productivity. Are you convinced?
We're going to wait and see. So I'm trying to take a wait-and-see attitude on all of this. What we're looking for are investments that can change the productivity of workers. And that's why we ask questions about capital expenditure and the like. We're hearing mixed stories about this. And so I think the jury is really still out as to how much extra productivity we should expect from these changes.
Now, the other big issue is trade. Do you know enough that you can estimate what the impact of the tariffs the administration put on steel and aluminum and may put on China will be? So the way that the proposals have rolled out, you know, they've shifted in terms of the details. And so the initial proposal for steel and aluminum was 25%, 15% on everybody. That would have been a very different impact than what wound up happening, where many, many countries were exempted. So what I've told our staff is, let's wait. Let's not be hasty about trying to model too much in the early stages as policy is being formulated, but rather let's wait and see what winds up actually happening and then make a reaction from that. So our guys, we think there's still a lot of uncertainty. I actually think there's a lot of uncertainty as to how this is all going to play out. And we'll just have to see sort of where the chips fall and what the administration and then China and others decide to do. Well, given that we have sort of a president by tweet, is that uncertainty causing businesses to hold off? Is Trump uncertainty causing businesses to wait on spending?
Well, what we've heard from our contacts, my board of directors and other business leaders around the 6th District, is that the uncertainty is making them nervous. And that nervousness is causing some to say, okay, let's wait and see sort of what the rules of the game actually are going to be. And so, yes, I do think that some of the way that policy is being rolled out and the uncertainty about the stability of policy is having an adverse impact. How much of an impact is it going to be, and how much is it going to affect GDP this year or next year? I don't know that right now, but we are hearing pretty consistent views that the uncertainty is not a positive.
Let's talk a little bit about the economy. In 6 days, we get the March CPI report. A lot of the temporary factors the Fed's been citing for a year now are going to drop out of the calculation. How much of a jump do you expect? And do you think that's been priced in?
So I do think that we're going to see inflation come in a bit higher, particularly year over year. We had some pretty low readings around this time last year, and they will fall out of the year as you said. So I think we're going to see an increase. I do think that there was initial expectation about inflation at the beginning of this year that got priced in. We've kind of backed off of that a little bit. And so I think some of it's priced in, but I think also the markets are doing the same thing we are, is really trying to wait and see what the numbers come in at and the dynamics around it to make an assessment about where inflation is.
Well, PCE headline last month was already at 1.8%. How soon do we get to or go over 2%? How far would you be willing to go over 2% and for how long? Well,
I think that, as you said, the trend is going in the right direction. And I think we're going to hit 2% sometime in the next quarter or two. I'm actually very comfortable going above the 2% to some amount, 2.2, 2.3. I don't think that's a crisis of overheating necessarily. And I think it's also important that we take a stance such that everyone understands that the 2% level is an average and is not a ceiling. And I have some concerns that we've been below for so long that if we go to 2% and do a hard stop and act aggressively to hold it at 2%, that will send a signal that we really view 2% as a ceiling. And I think that would be unfortunate and not helpful in terms of where we want inflation expectations to be.
Well, you've argued in favor of inflation targeting. Let inflation run above the 2% level for a while.
Yeah, so I actually think that the target, having a range and looking at it as an average over a certain period of time is exactly something that we should think about. So we just did a 4-part blog series on our website that really talks about the ideas of price level targeting and why we might want to be rethinking our current communication of strategy. That's something that we're going to have to discuss. We did this really to try to spark a conversation among academics and among market participants and among my colleagues to ask sort of how are our current frameworks working and do we need to change them?
Well, they've been talking about it. It was the subject of a conference at Brookings back in January. How close is the Open Market Committee to maybe changing its policy framework?
Well, I don't think there's going to be any change in the next 3 days or the next couple of weeks. I think this is going to be a conversation. You know, to get to the last framework, it took a fair amount of discussion and conversation over months and months and even a couple of years. So I would not expect there to be anything radical that comes out that would mark a significant deviation from how we've been applying policies so far.
You said that you expect maybe 2 more rate increases this year to get us to neutral and then pause and see where we are. But what is neutral to you?
So for me, I think neutral is somewhere in the 2.25 to 2.75 range for the Fed funds rate. A lot of the baseline analysis that we've done suggests that your risk-free rate is pretty low right now, and it's dropped over time. So I think that we're getting close to sort of the lower bounds of where I view neutral to be. And at that point, I think we need to just wait and see how the market responds. We've been in an expansionary and accommodating position for a long time. And I think getting us back to neutral is something that is a priority, should be a priority. And so I think the Fed funds level, we're kind of in a good place on that trajectory. And we're also unwinding the balance sheet to a more neutral position as well. I think that'll be quite helpful.
Well, are you seeing the neutral rate move up as the economy strengthens?
That's possible. That's something we're definitely going to look at carefully to make sure that we understand how these dynamics play out. I think that as the economy strengthens, as inflation gets higher, there is a possibility that free rate could increase, but we'll wait and see how that plays out.
We are talking with Raphael Bostic. He is the president of the Atlanta Federal Reserve on Bloomberg Television and Radio Worldwide. National Economic Council Director Larry Kudlow says that the president's tariffs will create faster, stronger growth in the long run. Do you agree with that?
Well, I haven't heard the whole transcript of his comments. I think that what we've seen in historic levels is protectionism tends to be difficult when it gets to economic growth. And so I would want to talk more with him to really understand his view on that. Now, of course, there are issues that they are trying to wrestle with in terms of fair trade practices. And to the extent that this strategy translates into practices being fair across the globe, then that's possible. But I don't think we have a strong experience with that over the history of this country. And so, I'd have a little bit of skepticism on that.
Well, we've talked a little bit about how businesses feel about the uncertainty from the administration. Markets have certainly felt the uncertainty, and we've gotten back to a much more volatile pattern. Does that concern you? Is it normal? What do you think of financial markets these days?
So, financial markets for a while, I think from the Trump election, for the next 16 to 18 months, really did not have very much volatility at all. It was going one direction. It was not really tightly connected to a lot of the data that was coming out. And so it doesn't surprise me that there is more volatility in today's era, and that volatility has been larger than historical levels, sort of a balancing out. I do think that also a bunch of the volatility has to do with uncertainty around policy. And so those reactions also make a lot of sense to me. Right now, I don't see the volatility as a fundamental problem that we need to be worrying about. But again, all of these things, it's a complicated economy. We have to be mindful and keep a tight eye on all of it.
Well, the flattening out of the markets has contributed to a tightening of financial conditions. Is that having an effect, do you think, on the economy at this point?
So we're not hearing that businesses are feeling real constraints in terms of getting access to capital. So right now, I don't think that this is a huge problem. But with all of these things, as rates increase, as debt gets more expensive, we're going to have to make sure that our policies are not contributing to a dramatic slowdown that could turn the economy in a negative way.
This is your first year as a voter. How do you approach that? What do you think of being a voter? Is it different?
I had basically 4 meetings before I became a voting member, and I thought I'd get in there, it's just like all the others, and just be different at the end. But it actually is different, right? When you hear your name called, and there's some weight to the whole thing, which has been quite interesting. I don't think I approach it any differently. We do the same preparation, but that moment when I have to say yay or nay, I do think about that, and it weighs a little more. But no, it's been a good experience, and I'm just happy that we are able to weigh in and contribute to the progression of policy in a way that the markets seem to be embracing, and I hope that continues.
The Yellen to Powell transition, how's that going?
It's been fine. Jay and Janet, they had worked together for a long time, and so I think that the thinking about policy is not that radically different. I think in the press conference, Jay, many people commented that he sounded like Janet with a different voice, and I think that's been good. I like Jay a lot. He is very direct and open and transparent, and I think that will serve us well as we go through our policy discussions and deliberations.
Speaking of people on the Fed, one of your graduate school classmates was John Williams. What does he bring to the New York Fed?
So John is a consummate macroeconomist. Many of the theories around how the economy should function at very low interest rates, he's an author of. And so he's really important. I actually am very glad that he will be closer to the chair on a daily basis. He had that relationship with Janet Yellen. I think that was very helpful. I think it'll be very helpful as well. And also, I think his style, it's good to have a different style that shows up. He's not Bill Dudley. They're very different people. I've enjoyed him through the many years that I've known him. We were classmates together, and I think it's a good choice, and I think the bank will do well by it.
We're talking with Raphael Bostic, the president of the Atlanta Federal Reserve Bank, here on Bloomberg Television and Radio Worldwide. John's been on the Open Market Committee now for 7 years. Does it really matter what coast he's representing?
I do think it does on some level. The New York Fed position it gives you a voice and a contribution to policy that's different than the other 11 reserve banks. You vote all the time. You're in conversations that the other presidents are not going to be in. So I think his perspective, weighing in at a very consistent level, does have the potential to change. And I think that having his economics expertise will be an important part of his contribution to the team.
The New York Fed made a big deal of diversity in its search process, yet they chose another white male. Even though you're a big fan of John Williams as the first black Federal Reserve Bank president, do you feel maybe there was an opportunity missed here?
So there's an opportunity. What I would say is this. I wasn't on the search committee, so I don't know all of the things that they went through in making their decision. I do know that there were minority candidates. I do know there were female candidates that were part of the mix. And how that chemistry played out between those candidates and the search committee are things that I don't have insight on. I do think that it's important that we continue to think strongly about, are we giving minority candidates a fair shot at these things? Are we giving women candidates fair shots to take on these roles? And I think that that as long as we're doing that and we can demonstrate that commitment, then we're in a good place. I will also say, I think John is actually very good when it comes to diversity. In his tenure at the San Francisco Bank, the senior ranks of the bank became much more diverse than they had been before. So I think that making sure that people who are appointed have a commitment to diversity is one of the most important things that we can do as a system.
Do you worry that politicians will impose it?
I haven't really thought about it that much. I know at our bank, we think about this a lot. We talk about this a lot. And, if politicians take actions, we will just respond in turn.